Welcome to the multiple step income statement. Looking at this statement, there are different colors to show us different parts of the statement. There are five major parts of the multiple step income statement, and there's also one part that shows earnings per share. Let's go through each of the five parts. Shaded in yellow, you'll find operating items. Sales less cost of goods sold gives us gross profit. That leads us to our very first key performance measure. It's a nice subtotal that our investors and creditors like to see. Operating expenses then are any other expenses that have to do with our day-to-day operations, and basically we can classify them into both selling and then general and administrative. If it's not a condensed income statement, then you'll have more detail under each of these two categories. In practice, companies use condensed income statements. So after we subtract out the other expenses required on a day-to-day basis, we're ending up with what's called operating income. So we have a second key performance measure that our investors and creditors like to see kind of out on its own. After we get past that, we have the section called Other Revenues, Gains, and Expenses and Losses. These are items that are not necessarily related to our day-to-day operations. In this area, you're going to find interest expense, interest income, dividend income, gains and losses on disposals of long-term assets. So it's things that happen in our business, but it's not the main reason we're in business. We're not going to be selling off the furniture in the corporate headquarters so that we can make profit on it. We're selling our inventory to make profit. So therefore, everything in yellow is our main reason for being, and the green stuff is peripheral. In blue, we have income tax expense all by itself. So basically, it's such a material item that it gets its own special little line there. So those of you who probably are in finance, we actually call income from continuing operations before tax, EBIT, earnings before income tax. So you may have seen it like that in another course. So income from continuing operations this is the part of the business that's going to continue into the future. Our next item is called discontinued operations. This occurs when a company is getting rid of one particular segment or component of its operations. So, for example, if a company is getting rid of its retail sales of some item but is keeping its services, then that whole retail part is being sold off. That's a discontinued operation. So basically, under discontinued operation, there's two major things going on. The company has been in business and doing business with this particular operation. It had revenues and it had expenses. So that first line is income from operations. It's what the business was doing this particular year. Since it's not going to continue, we want to separate those revenues and expenses from the ones shown in yellow. The second item in pink is called loss from disposal. So when you're getting rid of a segment, you're getting rid of all the long-term assets and all the items related to that particular segment. And you might have gains, you might have losses. Typically, if you're selling off a segment that's not profitable, you're more likely to see a loss there. So we aggregate those two together, and we have a net loss on discontinued operations net of tax of $2,700. That leaves us with net income. So what we've gone through is yellow is the operating, green is the non-operating, more peripheral, blue, income tax, pink is discontinued, and that gives us net income. The next few lines are earnings per share. It's required by GAAP to show earnings on a per share basis. So in order to get earnings per share, let's look at $2.01, that last line there. That is taking the net income of $80,200 and dividing by the number of shares outstanding. When we have discontinued operations, then we do actually have to separate and give a little bit more detail. So we provide the income from continuing operations, and that is the number after tax, the 111, 150, and divide that by the number of shares. Then we take the discontinued amount, 2700, divide that by the number of shares. That way we can see the actual significance of discontinuing that operation. Now think about it. Which number do you think is the most important for shareholders, for creditors? They're interested in continuing operations. That $1.94, that's more likely to continue. But the earnings per share basis is very important because often financial analysts have predicted it, and we want management to, that's kind of the benchmark. So we're looking, when there's an earnings per share announcement, we want to see that they met or exceeded the earnings per share. And if they didn't, we want to know why. So 4 major parts: yellow, green, blue, and pink. Under other comprehensive income, we've got some items here that are a little bit different from the stuff that's on the top part, the income statement. So we're going to talk a little bit more about these in a different video, but OCI basically arises because we use fair value measurement on some items on the balance sheet. And the items that are in OCI tend to be items that are less certain, and they are likely to kind of flip back and forth. You might have a gain this year, a loss next year. If you were to introduce all these items into the net income part of the income statement, it would cause earnings volatility. And all the items under OCI are items that are less under management's control than the stuff that's typically represented on the net income statement. So it's a win-win here, and we'll talk more about that in a minute. So basically, there's 2 ways to present comprehensive income. You can do one huge statement starting with sales, going all the way down to comprehensive income. And in that case, net income plus OCI gives you comprehensive income. So that's one format. The other way you can do it is 2 separate statements. You have your net income on one statement, and then the second following statement is the statement of comprehensive income. It starts with net income, and then it adds in those OCI items, ending with comprehensive income. So 1 or 2 statements, either way, is acceptable by GAAP. And that is a quick summary of your multiple step income statement.